Good morning and welcome to The Street on BNN Bloomberg. I'm Roger Peterson. Thank you very much for joining us. Coming up on the show today, we'll be joined by our guest co-host this morning, Brooke Thackeray. He's research analyst at Global X. Later, our featured guest from Asante Capital Management, Tina Tarantian. We'll dive into the world of philanthropic investments with us. And of course, we want to hear from you on First Call. Call us with your questions on North American large caps, and we will have Brooke answer as many of them as he can. The number to call, 1-855-326-6266. And the phone line's open in about 30 minutes from now. Our email address is firstcall@bellmedia.ca. Now, here's some of the stories we're tracking for you in the BNN Bloomberg newsroom. Thousands of customers across Ontario's Waterloo region were left without power Sunday evening as Annova Power reported at least 15 outages. Affected areas included parts of Kitchener, St. Jacobs, Maryhill, and surrounding rural communities. The outage disrupted a hockey game at the Kitchener Memorial Auditorium as well, cutting power with 2 minutes left in regulation. Backup lighting came on shortly. Play resumed following a delay. Annova has not yet released a cause or restoration timeline for the outages. Ukrainian President Volodymyr Zelensky says he asked U.S. President Donald Trump for a 50-year security guarantee as part of talks aimed at ending Russia's war on Ukraine. Speaking after meetings at Trump's Mar-a-Lago resort, Zelensky said key issues remain unresolved, including control of eastern territories and a Russian-occupied nuclear plant. Trump said progress is being made, but no timeline has been set. Moscow continues to press for maximum demands, while European leaders prepare further talks in early January. Copper prices surged to a record near $13,000 US a ton on the London Metal Exchange, extending a sharp year-end rally driven by supply fears. Prices jumped more than 6% at the open before pairing gains, while U.S. futures retreated. Investors are racing to move metal into the U.S. ahead of potential import tariffs under President Trump, tightening supply elsewhere. Analysts caution prices may be running ahead of fundamentals, especially as demand weakens in China, the world's largest copper consumer. SoftBank Group is said to be in advanced talks to acquire Digital Bridge Group, a U.S.-listed investment firm focused on digital infrastructure, including data centers. Sources say a deal could be announced as soon as Monday, though terms haven't been disclosed. Digital Bridge shares surged more than 50% in pre-market trading. Digital Bridge manages about $108 billion U.S. in assets and owns stakes in major global data center operators. And now our top line story. Shares in U.S. silver stocks are pulling back in pre-market trading this morning as the precious metal retreated sharply after smashing through $80 an ounce for the first time last week. For more on this, taking a look at some of those stocks right now, you can see they're all off 3%, 2%, 4% for First Majestic Silver, Pan American Silver up by a little more than 3%, and Wheaton down by nearly 2%. For more on this, let's bring in our guest co-host, Brooke Thackeray, research analyst at Global X. And Brooke, thanks as always for joining us, especially on the holiday week.
Oh, it's a pleasure to be here.
You wouldn't miss it for the world,
no,
right?
Not at all.
Family, festivities, fun. You'd rather be here talking with us. Thank you, though, for joining us. Always appreciated. What a weekend for silver. I went away last Tuesday, come back, and it's a whole new world.
Yeah, there's been a lot of excitement around silver. I mean, it's up 170% for the year, and it's being squeezed a little bit. And it's been in the news a lot, making all-time highs. And there's been a couple of developments that have been taking place here. And there's talks about shortages, and that's just pushed retail interest up. So what we've seen is over the last week, this is the holiday season, so it's not a large volume season.
Yeah, it's a skews it a little bit.
Yeah, it skews a little bit because it's the institutions have stepped away, and the retail players are actually the ones really pushing the market more so than compared to other times. So a little bit of illiquidity, and late in the days, a short trading volume. All of a sudden on Friday, you saw silver just run up 9% on the day.
Wow,
huge gain. But a little bit of warning on that. It's a parabolic move. We've seen it's overbought at this point. We expect some choppiness. Sure, the long-term picture is great for silver. we don't have enough of it. We've been in a deficit for the last 5 years, demand versus supply. This is the problem. And we just see more and more usages of it as we go more into EV cars, solar panels, et cetera.
And that's a big thing with silver, right? Compared to gold, people are using silver.
Yeah, so about 59% of silver produced, mined, is actually used for industrial purposes, and which is a huge number. And that's only going to grow. So we see the industrial usage going up over time, and we also see a lot of the monetary investment as well. But there's a couple of recent developments that have taken place in silver. One is that today, on Friday, I should say, the CME Group, COMEX, basically came out and they raised the margins on both silver and gold. And usually what that does is it at least provides a little bit of a dip, because now you have to use more collateral to use the futures products. So now it reduces the amount of leverage and pulls back the amount that can be invested a little bit. So usually you see a little bit of a dip in this case, silver, because of that. It doesn't mean it'll last long, but we're seeing silver pull back today, and that's one of the reasons. It's just because it's an increased margin requirement.
Do you think that will hold? Because they tried that earlier in December, and it really didn't do much.
Yeah, so they did that on December the 12th. They came along and said, well, let's raise margin requirements. And they're doing it because of volatilities going up, and they have to cover themselves, and that makes a lot of sense. But there's a small dip, and then silver ran ahead. Usually it's the second or third time when they start to increase the margins, it tends to have a bigger impact, not so much the first time. There's other factors at play here going on here. China is basically saying that, you can't export silver out of the country without permission or access. You have to get a permit to do that. And China is an interesting player because they're the largest users of silver. They also refine
65% of the market. Did I see that number correct?
65% of the refining. So they're the largest refiners in the world by far. So they import a lot and they export a lot. That's because the refiners are so big, and they're the second biggest producer for silver. But they export huge amounts because of the refining capacity. And now if they're coming along and they're really starting to clamp down on this whole exporting of silver leaving China, companies are concerned about that because it's an industrial use product.
Absolutely.
Basically.
I mean, especially I imagine with tech, that's a huge concern.
Absolutely.
And solar was one of the other ones you talked about?
Solar is the biggest consumer. But tech, it's more of a critical. I mean, it's not a large percentage of the cost. Solar panels, it is. EV cars, but when you start to use more silver. But tech, it's not a huge portion of the cost, but it's a critical mineral that they actually need. And it's actually a critical mineral on the U.S. list as well. So if they don't have silver, then they're in trouble. An interesting development that happened not so long ago, and that was Samsung came along and they invested $7 million into Silverstone mining for their La Perilla mine in Mexico. And for the rights to buy 2 years of production from the mine. And so they're locking up the production. So now they know they have that silver in case there's shortages in the future. I think we're going to see more of this, by the way, in 2026, where companies are buying out there's part of the supply chain.
Almost silo, right? So they have it coming straight from the mine without having to deal with anybody else.
And making sure that they can get the delivery of it on time, when they want it and how they want it. They can say, well, here's our guaranteed supply source. And we've seen the U.S. government do that in 2025 with critical minerals. I think companies are going to start to take a look and go, hey, you know what? We need to lock in a little bit of copper here in the future. Maybe we should actually buy that supply stream coming from a mine or silver or whatever it is. I think we're going to start to see more of that trending higher in 2026.
And could you see, just before we go, could you see China cracking down further, tightening it up even further?
I think so. I mean, well, they crack down with the rare earth metals. It's moving benchmark because they do it. The U.S. comes back and says, hey, you can't do that. And then they adjust it accordingly, but they're still doing it, even in rare earth metals. So I think their goal is to really try and really tweak that whole system. So it's not just, hey, we're outflowing rare earth, we're outflowing silver. So I do think this is a concern for the future.
Okay, we're going to leave it there, but we have lots more to talk about with Brooke when we come back. But up next, Canada's job market could be in for a shakeup as growth slows and unemployment risks rise. We'll dig deeper with Brooke after that. Let's see how things are shaping up on the markets right now. We start with U.S. futures. They've been flat right now. They're actually moving a little more, moving down though right now. The Dow was off by 0.1, almost a wash, but the NASDAQ off by 0.44, and the S&P 500 down by about a quarter point. Asian markets all slow and down today. Nikkei off by 0.44, Hang Seng down by 0.71, and the CSI 300 off by 0.38. And moving over to the European markets, pretty much flat everywhere you look. FTSE 100 down slightly, 0.03%, hardly worth mentioning. CAC 40 up by 0.1, and the German DAX down by 0.1. Let's see where the TSX finished the day on Christmas Eve in a shortened session. Was off from its record high. Gold and other mining stocks dragging the market down, and closed just below 32,000. Some of the winners and losers from trading. Brookfield, pretty minimal movement. Brookfield business up by 2%. Go Easy 1.72%. Going the other way, Seabridge Gold down by 2.6%, and Perpetual Resources off by 4.3%. And this is what everybody's talking about right now. You can see a little bit of a drop after that crazy surge for silver. It was up over 80. It's down now around 75, down 2.7% right now. And gold is also off 1.6, copper down as well. All of them, though, still up near record territory. And looking at oil, it continues to struggle. Western Canadian Select, no change from Wednesday. And south of the border, a look at WTI. A little bit of a surge up above 58. It still down for the year and was at a 5-year low just a week or so ago. It's up 2.5% right now. Well, Canada's job market has been in a no-fire, no-hire holding pattern, but that could change as growth stalls and productivity remains weak. Some analysts warning that unemployment could climb toward 8% next year. For more on this, let's bring in Brooke Thackeray of Global X to talk a little bit about those numbers and what we should be concerned about. That's been the talk, is the no hire, no fire. I have friends, they say, we've looked, there's nothing out there, but nobody's being let go from their companies.
Yeah.
But
yes, and no hire, no fire, and no quit.
Yeah.
So it's like if people aren't quitting now, they're saying, hey, we got to hang on.
You're hanging on right now.
So we're in this really static environment, and everybody's trying to figure stuff out. So you're finding companies going, white-collar companies are saying, well, do we really want to hire? Maybe we'll try this AI. We have to be certain about AI first before we make any decisions. And companies have been really reluctant to let people go. But if you take a look at the productivity numbers have actually been going down. So the labor productivity has been going down. Normally, this is when they start to let people go because there's not enough work coming out per person because there's just not enough work. So they've just been reluctant to let it happen. And at some point, companies are going to have to make that decision to say, okay, we're going to have to start letting people go. I think that could be in 2026, we're going to start to see this uptick in both Canada and the US. Now, in Canada, we saw that strong unemployment report where it went,
I think it caught a lot of people off guard.
Yeah, it did. It went from 6.9 to 6.5%. It was like, wow. But that's more of an anomaly. I think we're going to start to see it climb back up. And I do think we're going to start to see perhaps go 7.5, and maybe at the tail end of the year, get closer to 8%, which might be a little bit of a concern.
Where does that leave this country then?
Well, it's not a good picture in the end. And if it starts to ripple through, if we start to get a housing slowdown as well, we've got a lot of mortgages coming due. If that does take place, that will also be a key factor here. But we'll start to see more of a stagnation take place, where we'll have low economic growth taking place with inflation that still hasn't come down to target. It's not like a huge stagflation where you got 8% inflation, but let's call it a mini stagflation type of thing. So inflation above where it should be, and a low growth environment for Canada.
Now, and will certain areas be hit harder, certain regions or certain industries be hit harder? I saw some numbers from I believe it was the Fraser Institute about Ontario, and I mean the GDP in that is down per person, and even though they're the population's up, they're down the numbers. So is that where we'll see it, manufacturing?
I think so, absolutely. I think so. Ontario, being one of the major manufacturing hubs of Canada, can be the most affected here. And if you take a look, the taxes, tariffs, whatever taxes, are really a strain on the whole manufacturing process. And companies in that area are saying, well, we're not sure about free trade with the U.S. coming up as well. And they like to have that free trade going back and forth across the border. So
it's our livelihood.
It is our livelihood.
Especially in Ontario.
Yeah. And overall, I don't think, no matter what the outcome, I think it's not going to be a rosy picture for manufacturing so much for Ontario. So I think Ontario is actually going to be one of the hardest hit provinces as far as unemployment goes in 2026.
And what about industries? Any particular industries can you see?
Well, I think manufacturing, as we discussed, would be I think the biggest industry being hit. The energy industry, I think, can actually do well here. I mean, as far as that side goes. White collar, I think we're still going to see that grind slower, where companies are going to start saying, well, we have to start letting people go. But the biggest will be manufacturing, and then white collar after that.
Does it feel like with white collar that 2026 might be the year that AI really does kick in? And when it comes to those jobs that can be replaced by AI?
That's a hard one to say for that inflection point, because most companies have really struggled, like the technology companies.
To make AI fit.
Yeah, to make AI fit. And say, how do we do this? And I still think that might be out a couple of years where they start to really say, hey, we're really making strides with this. And but I still think companies are going to hold back in hiring and start, really trimming back their workforce in preparation for that better use of AI, because the labor productivity just isn't as strong as it should be. And they're saying, well, perhaps we'll let people go and figure out how we use this AI as we go forward. So I think really it's a little further out for AI.
Okay, we're going to leave it there, but lots more to talk about coming up. Rising government debt and higher rates could mean bigger borrowing costs. We'll dig into what that means for the markets after the break. Rising rates are putting pressure on government borrowing costs, and investors are demanding higher yields. Could long-term rates climb even further in 2026? And to offer up some answers for that, of course, Brooke's been here all morning. Brooke Thackeray of Global X. Talk a little bit about that. I guess the first question, do you think we'll see that?
Yeah, I do think we'll see that. I think at the long end of the curve, we'll see rising rates. A lot of investors, take a look and they go, oh, the Bank of Canada's cutting rates, which is not expected right now, by the way, or the Federal Reserve's cutting rates. So therefore, the rates are going down across the curve. But that is not necessarily the case. It's the long end. The central banks really don't control that unless they're doing some sort of quantitative easing program at that part of the curve. And they're not. And they have no plans for that. So we'll probably see rates rising because investors are starting to say, well, you know what? There's still a lot of government spending in Canada, the U.S., U.K. So it's right across the board. And we're seeing all these rates go up higher over time. So what does that mean? It means the longer-term bonds may not have the gains that people expect, or might be negative as well. And it's going to be more costly to finance projects over the longer term as well.
So what do investors do with this? What are investors doing with it? And longer term, are you talking 10 years?
So, when I talked at least 10 years, when I say longer rates, 10 years to, 30 years basically, and even at 20 years at that part of the curve. So what do investors do with this? Well, if you take a look at Jeffrey Gundlach, who's well followed in the States, came out and said, well, an allocation of 25% to gold, given bonds and the rising yields, it's not crazy. I'm going, well, that kind of is a huge amount in a portfolio. And then we saw Morgan Stanley come out and say that, 60-40 has now changed to 60% equities, or perhaps the CIO of Morgan Stanley said, perhaps we move to a 60% equities, 20% bonds, and 20% gold. So a lot of people are looking at the precious metals as that alternative.
As the new bond almost.
Yeah, but there's no income coming off of gold. But they're saying, well, where do we go? Are we looking for some different replacement? I'm not suggesting those numbers are applicable for people here. But it's just tougher at the long end of the curve for investors. And so I think what we're going to see is we're going to see more investors invest more at the shorter end of the curve rather than longer bonds continually say, I'm going to hold that longer term bond because it's uncertain if the rates are going to keep rising. Even if the economy slows, if the government continues to spend money, we still may see interest rates at the long end of the curve go up.
What will that do for the short term, though, for the shorter?
Well, so the short term is really controlled by the central banks, and they're pushing that down longer term, basically. So the short term, I think, in the U.S. we'll see go down here. We'll see a couple of cuts in 2026 in the U.S. In Canada, we won't necessarily see a cut. So I'm expecting the short term rates just to stay where they are. Mm-hmm. It's interesting. The Bank of Canada is actually buying T-bills. It's not quantitative easing, but they're buying T-bills. Right from the government at primary auction. Which is I know.
Okay.
But they say they do this, this is part of their routine policies, but they're doing this because the current government's selling so many T-bills to pay for their deficits. So they're just buying them at the front end to provide the liquidity in the market. And that's their primary purpose at this point, which is helping to keep the rates lower at that point. Because if they weren't doing that, we'd actually be seeing the short rates go higher here because the government was issuing more and more short-term T-bills to finance their debt.
And what does this mean for the government itself then, if people are shying away and dropping their percentage like from 40 down to 20, say? If they're not attracted to bonds overall, that basically means we'll see interest rates move higher again, because if the demand's not there for them, because people are saying, hey, we're shy on these, then that means that the price for bonds actually decreases because yields are going to go up. They're going to have to pay higher and higher yields. So it's a little bit of a self-fulfilling prophecy. To get more people, they need to sell the debt. And to get more people, they're going to have to raise the rates, basically is what it comes down to. So once again, that pushes rates higher. Okay, we're going to leave it there. But coming up, our next guest will be talking about the best practices on how to navigate philanthropic investment. And of course, our phone lines will be open soon for our first call segment. You can reach us at 1-855-326-6266. Send us an email, firstcall@bellmedia.ca. Ukrainian President Volodymyr Zelensky says he asked U.S. President Donald Trump for a 50-year security guarantee as part of talks aimed at ending Russia's war on Ukraine. Speaking after meetings at Trump's Mar-a-Lago resort, Zelensky said key issues remain unresolved, including control of eastern territories and a Russian-occupied nuclear plant. Trump said progress is being made, but no timeline is set. Moscow continues to press for maximalist demands while European leaders prepare further talks for early January. Copper prices surged to a record near $13,000 US a ton on the London Metal Exchange, extending a sharp year-end rally driven by supply fears. Prices jumped more than 6% at the open before pairing gains, while U.S. futures retreated. Investors are racing to move metal into the U.S. ahead of potential import tariffs under President Trump, tightening supply elsewhere. Analysts caution prices may be running ahead of fundamentals, especially as demand weakens in China, the world's largest copper consumer. SoftBank Group is said to be in advanced talks to acquire Digital Bridge, a U.S.-listed investment firm focused on digital infrastructure, including data centers. Sources say a deal could be announced as soon as Monday, though terms haven't been disclosed. Digital Bridge shares surged more than 50% in pre-market trading. The move would align with Masayoshi Son's push to capitalize on AI-driven demand for computer power. Digital Bridge manages about $108 billion U.S. in assets and owns stakes in major global data center operators. And a quick peek at the U.S. futures right now. You can see a bit of a downward trend. The Santa Claus rally will continue, but right now everything is off. The Dow down by 0.12, with the Nasdaq off by 0.47, and the S&P 500 down by 0.29%. Well, we are nearing the end of the year, and that means it's best time to get into some philanthropic investments. I still got a bit turkey brain going on there to receive tax credits before the December 31st deadline. With decades of experience in the field and guiding her clients on the topic, we are here to talk philanthropic investments with Tina Taranchian, a senior wealth advisor for Asante Capital. Tina, thank you very much for joining us. And I'm not going to say philanthropic any more today. That's it. I'm done.
You managed.
I got through it the second time. Every time it gets it perfect there. Let's talk a little bit. It's the end of the year. There's two different things. There's philanthropic investing and then also philanthropic for when it comes to your taxes. This time of year, is there things you can do to kind of offset your taxes? As you know, we're almost out of time, but can you still do anything in this last little while?
Yes, definitely. You have until December 31st to make a charitable donation and benefit from the tax credits. It's a non-refundable tax credit, but it will reduce your taxes dollar for dollar for 2025 as long as you make the contribution before the end of December. Now, cash contributions are easy. You can just go online and donate to any charity that you like. But if you have appreciated securities, you're better off donating those securities in kind because all of the capital gains on those securities will be eliminated and you will get the same charitable donation tax credit that you would if you were to donate cash. Time is tight right now. It usually takes some time to re-register securities from a brokerage to the brokerage of a charity. So you may still be able to do it, but it's a stretch because of the short time period left.
And what's the best way to decide which ones you might want to get rid of at this point?
That's a good question. So your best bet is looking at securities that have the biggest appreciation and donating those, because as I said, you will get rid of
appreciation or
100%. Appreciation.
Appreciation, okay.
You will get rid of 100% of the capital gains that has accrued on those securities. Now, if you like those securities and kind of don't want to donate them, you want to keep them in your portfolio, you can still do it because if you had the intention of donating to a charity, you probably had set aside some cash to do that. So you could donate the stocks, get rid of the capital gains on those stocks, and then use your cash to buy back those stocks in your portfolio, the cash that you wanted to give to charity. Now, your cost base is higher, your entire capital gains is eliminated, and if you own those stocks in a holding company, if you're a business owner, if you have a holding company, there are extra tax benefits because 100% of the non-taxable portion of capital gains is credited to a notional account for a corporation. It's called a capital dividend account. And then the business owner can draw that money out tax-free from the corporation. When you donate stocks, 100% of the gains are eliminated. So you can withdraw 100% of the capital gains that you had on those appreciated stocks out of the corporation on a tax-free basis through the capital dividend account.
Okay.
Sure. Yeah. What about using RSPs? I mean, is there something that you can do with that if that's what you have all your assets in an RSP?
To make charitable donations? Yes. Well, the problem is that when you pull money out of an RSP, it's considered income. So it's 100% taxable. Now, we do recommend that for people who have a RIF. They have no choice but to withdraw the minimum income. If they do not need that income, then it is a good idea, if they have charitable intentions, to donate that money to charity to offset the taxes on the withdrawal from the RIF. But if you do not have a RIF and you do not have to withdraw from an RSP, usually you're better off donating appreciated securities or cash.
Yeah. Do you find this is increasing, charitable donations in society right now? Is that an increasing trend that's taking place?
You know, unfortunately, the number of tax filers who are donating to charity has declined quite a bit. However, the total amount of donations has been increasing. So the wealthy are giving more, which is good. At least, charities are not suffering. But we are seeing a general downtrend in terms of the overall number of people who donate.
Let's move on a little bit to the philanthropic investing. What exactly is that, and how do you choose, or how do you set up a portfolio with that?
Well, one of the relatively new tools that's been around for a while is a donor advice fund. So in the past, wealthy families would set up a charitable foundation. It requires a lot of work because you have to have a board, you have to have minutes, you have to file tax returns for the charity. It's not easy. In the last few years, there's been a big uptick in donor advice funds where a public charity manages all the compliance issues for the donors, but then you control the giving. And donor advice funds are great when you have a big tax problem in 1 year. It could be maybe you sold a lot of stocks in your portfolio to rebalance it and you realize a lot of capital gains. Maybe you sold your business and you have a liquidity event and you have a huge tax problem in that year, but you cannot decide which charity to give to. Some people have regular donations that they make to charities every year, and they want to keep doing that rather than give $1 million in 1 year to charity. So donor advice funds are a great way of looking after the tax problem, getting the charitable donation tax credit in the year that you need it, and then investing the funds in the donor advice fund until you decide who you want to give it to and what amount. You have to grant a minimum of 5% of the amount that's invested in your donor advice fund, but the rest of it can stay there and grow, and then ultimately you grant it to different charities, and you can leave wishes with the donor advice fund in terms of what happens when you're gone. Maybe you want your children to keep managing it. Maybe you want everything to be donated to charity right away when you're gone. So there's a lot of flexibility around that as well.
We're almost out of time, but Brooke will give you
I
the
was
last
going to
question.
say, so it sounds like a mini foundation then.
It is. It is a mini foundation without the headaches.
Yes.
Because all the tax compliance, reporting, everything will be done by the public foundation that manages it for you.
Okay, we have to wrap it up there, but Tina, thank you very much for joining us.
My pleasure,
We appreciate you
Roger.
coming in. Thank you.
Thank you.
It's Tina Taranchian, is a senior wealth advisor for Asante Capital. Still ahead, today's market drivers with Bloomberg's Divya Balji. And of course, our phone lines are open. Brooke will take your questions on North American large caps. You can reach us at 1-855-326-6266 or email firstcall@bellmedia.ca. Okay, for a look at some early market movers, we are joined by Bloomberg's Divya Balji. She is the managing editor for breaking news in the Americas. Divya, thank you as always for joining us. And it's the holidays, so we're talking Trump, which is not traditional. Well, he's always business some way or another, but he had that meeting with Zelensky. He's meeting with Netanyahu in Florida. It's a busy time. What's going on with all that?
Yeah, I mean, I don't think this is something you would have seen from a lot of other presidents of the United States, but he is in Florida right now. On Sunday, he had a big meeting with Zelensky. I think the overarching view here is that there was no breakthrough deal that was announced from this meeting. They both left feeling very positive. They came out talking about it like there were a lot of discussions that were held that could move them in the right direction when it comes to Russia. Now, I think the key thing here with these discussions is that Zelensky wants, a very long time frame where there will be no invasion by Russia. 30, 40, up to 50 years is what Zelensky's asking for. He's optimistic. He feels like if Trump can make this happen, then it is truly a breakthrough in what has been going on since 2022 between Ukraine and Russia. Now, Trump has gone back to say he needs to talk more with the Europeans. He obviously needs to talk to Russia and Putin as well. That's something else signals we're waiting on, and that there will be more conversations had in January too. So that is one aspect of this, that is Trump and Zelensky and possibly Putin as well. And then we're having this meeting in Mar-a-Lago as well, in Florida, where Israel is coming in. Bibi is coming into Florida to sit down and chat with Trump about the ongoing, issues and the hostility between Israel and Hamas. Things have certainly been going in the right direction, but I think Israel is still a bit frustrated with where things stand right now. Is there a ceasefire? Is Hamas still fighting back a little bit? There's still that whole thing about hostages and the remains of hostages that Hamas is still holding on to. Now, the question is will we actually see some sort of definitive thing come out of these discussions today? People are very unsure about that. Is this just further discussions before they take it to that final place? It's really unclear at this point. And we all know that, it could be a quiet week for us, but that doesn't mean it's a quiet week for Trump, someone who is trying to show that he can be a peaceful leader of the world. So who really knows? But we're definitely all eyes on this meeting that's happening at 1 o'clock today.
I don't think he ever has a quiet week. Okay, SoftBank Group also up. They're looking to buy Digital Bridge. It's a private equity firm that invests in things like data centers. How's that shaping up?
Yeah, that deal just got announced a few minutes ago. They are buying Digital Bridge for $16 per share. What's interesting here is Digital Bridge is an alternative asset manager that owns digital assets, that owns data centers, that is very heavily invested in artificial intelligence. The question here could be, why is SoftBank buying this company instead of just going out and building the infrastructure for AI, instead of just buying data centers themselves? And I think basically the speculation here is it's two things. One is this acquisition allows SoftBank to gain access to executives that are very comfortable managing this portfolio of various digital assets and infrastructure. It also gives SoftBank access to investors that have put their money into these portfolios as well, which then they could use in their other investments as well. So a pretty interesting way of this deal playing out. How is SoftBank going to go further into this is yet to be seen, but this is one foray into it where they're not physically owning the assets, but they are owning a portfolio of assets that could help them down the road in AI.
Okay, Divya, we'll wrap it up there. Thank you, as always, Bloomberg's Divya Balji. Still ahead, we'll take a look at some of the notable analyst calls and recommendations moving the markets, including a cut for Amicus Therapeutics. Let's take a look at some of the notable analyst calls and recommendations. Pretty quiet on Wall Street, but we do have two new analyst ratings this morning. First up, Leerink has cut their ratings of Amicus Therapeutics to market perform from outperform with a price target of $14.50 US. The analyst report citing worries over the BioMarin acquisition, saying it appears to be getting a favorable deal in the acquisition. Amicus is a global biotechnology company that discovers, develops, and delivers novel medicines for people living with rare diseases, particularly rare metabolic diseases. Next up, Singular Research has initiated coverage of Jefferson Capital with a buy rating on the stock and a price target of $27 US. Jefferson Capital is a major debt buyer and collector that purchases old, charged-off consumer debts. Well, a high-stakes meeting that could potentially lead to the end of the war between Russia and Ukraine took place in Florida yesterday between the Ukrainian and U.S. presidents. But as Kamal Karamali tells us, there's some sticking points that could slow down the process to a peace deal.
This is the meeting that could spell the beginning of the end of the nearly 4-year war between Russia and Ukraine.
We covered, somebody would say 95%, I don't know what percent, but we have made a lot of progress on ending that war.
Ukrainian President Volodymyr Zelensky in Florida to try and get U.S. President Donald Trump to sign off on his 20-point peace plan.
Of course, if we will go further, and I hope that really we will have decisions in January.
Those steps involve Russia being a willing participant, which is still in question. One of the key sticking points include territory in eastern Ukraine. Ukraine has said it is willing to withdraw troops if Russia does the same and allow the region to become a demilitarized zone.
That is beneficial both to Ukraine and not to Russia because they don't want to move off of the front lines at all. They want to keep the line right where it is.
Ukraine is also looking for security guarantees, support from other nations should Russia attack again.
Those security guarantees will be provided not only by European and NATO nations, but in the 20-point plan, it specifically spells out the United States. And President Trump has also indicated that the United States is prepared to do that.
Part of the reason why rounding up support from Canada and European leaders was so important before meeting Trump. Although time is of the essence for Ukraine, Trump had this to say before the meeting.
I don't have deadlines. You know what my deadline is? Getting the war ended.
Zelensky claiming Russia doesn't want to negotiate under peaceful terms, pointing to the attack on Kiev earlier this weekend, but Trump maintaining both sides want a peaceful resolution. Kamal Karamali, CTV News, Toronto.
When we come back, Brooke Thackeray will take your questions on First Call. All right, time for First Call, and actually first email this time. It's from Mark. He says, what percentage would you suggest for cash in an account over the next 6 months? Thank you. What would you do, bro?
That's a loaded question because it really depends who you are, what your investment objectives are, how old you are, when you're going to need the money. I will say this. You want to set up the parameters. You want to set up a band as far as saying, here's my parameters. Here's how much I want to be in equities and fixed income or precious metals or whatever you're doing. And there's a tolerance with cash. The danger about going to cash for 6 months, as an example, with a whole huge amount of money is if it goes up.
Yeah.
You say, well, hey, it went up. Or if it goes down, you go, oh, it's going to go down further.
Yeah.
So it's a very difficult thing to do. I'm not saying people don't do it. And I focused on seasonal investing, which has a bit of that in it for sure. But I think you have to have your risk tolerances and to say, obviously, it sounds like this caller is concerned about the market valuations if they're asking a question about that. And so what you'd say is, how much cash would you normally have? You set the parameters out and say, how much equities would you have? And maybe you bump that up in the band, but you still have to make some decisions later as well. So there's no magic number to say that, hey, here's the percentage cash that you should be for anybody. But if you're concerned about the market valuations, you could say, well, here's how much I'm going to go into short-term fixed income or cash or something like that. But I'm going to have a date, sort of like a stop loss, and say, I'm going to do something down here. I don't want to be sitting here for 5 years, as an example.
Yeah. But what if that date comes and it's still not clear? What do you do? Do you put a new date?
Well, you don't want to roll it over per se. You want to say, well, maybe I was wrong in making a cash allocation.
Yeah.
As far my cash allocation there, and the market's changed or whatever. At least reevaluate whether you should be going back into the market. So it really depends on your individual needs financially and your risk tolerances combined both. And it's okay to use cash as a strategic investment for a smaller part of the portfolio, depending on who you are. But you have to have a date where you say, okay, this hasn't worked out and the market's continuing to move higher. I need to have plans
to put it back to work.
Put it back to work, maybe in more conservative areas of the market. Maybe it's not, hey, let's just take a whole bunch and put it into cash. Maybe you need to have more conservative investments. Instead of investing in AI, as an example, you go back into lower beta stocks or sectors.
Okay, let's get another email in here. It's from Glenn. It says, can I please have your opinion on Tesla? I think everybody has an opinion on Tesla.
Yeah. So here we are. They've done extremely well. I mean, you take a look at the other Mag 7
Considering
stocks.
what Elon Musk has gone through over the last year or so with the president and everything like that, but Tesla's done extremely well. You can see here it's reached all-time highs, I think, or bounced back up here recently from February. And it's actually been leading the market in the last little bit, coming towards the end of the year here. My viewpoint on Tesla as a stock, forget nothing to do with Elon Musk or anything, but it's the Chinese
cars, BYDs, they're making huge inroads in exporting cars to third world countries. So if you go down to South America, you just see increasing numbers of Chinese EV cars. And so they're stealing the market from these established companies like Tesla. So I think longer term, unless you really believe that Tesla is really going to come out with more robo-taxis and that's going to change the world or whatever, but if you're looking at just from an EV market, we're seeing countries and companies back off EVs because they're not being accepted as fast. And we're seeing China really dominate that market from the bottom end. So it's a tough market. This is not a company that I think in the next year or so, I think it's going to have its issues here at this point.
Okay, well, we're going to see again. We thought we could sneak in one more email, but we are pretty much out of time. But so Tesla, you think we'll continue a little bit with Tesla. You think it's for now, but not for long?
I would say I'd be looking to exit this stock coming up shortly. I think a lot of the reason that people have moved into Tesla, it's more about the momentum play. The market's going up, and they say, "Hey, I want to get in as part of that." And they're looking at some of the futuristic things with robo taxis and all of this sort of stuff. But I think longer term, from the EV side of the business, I think they're in trouble. So I would actually be looking to fade this company. In other words, start to exit.
But is there still the Musk factor? Like, there's not many other companies where you can talk about the CEO being such a figure in it.
Yeah, I mean, it's been a positive and a negative, and depending on who you are, and as far as Musk goes. And sure, I mean, he signed up for a $1 trillion pay package if the company makes so much money or he gets a certain level at a certain time period. There's a lot of promises made as far as that goes, and I'm not sure that they're all going to be made.
They're all going to be made. We got to wrap it up there. Brooke, thanks as always for joining us. Always appreciate it. That is it for us here on The Street. Thanks for Brooke for joining us today. And we're sticking around. I'm sticking around for the Open. That's next. The markets will open in 30 minutes from now.